Hey everyone, my name is Reese, and in this video, I will be talking about what I consider to be a pretty hot topic of debate, and I will be looking into some of the key differences between value and growth investing and which type of investing strategy may suit your needs depending on your risk tolerances and investment goals. And so to start this off, I'm going to be talking about what growth and value stocks means when someone's talking about what something's a growth company versus a value company. So the source for this is a Merrill Bank of America company from their website. And so growth companies you're investing in rapidly growing companies or companies that you believe will grow in the future. And then value based investing is investing in companies that might be considered undervalued by maybe they're in a financial down, like the sector's currently in a downturn, or a company has strong fundamentals financially, but maybe their stock price doesn't reflect that. So when you're investing in a value based investing strategy, you're betting that that company will have be able to get through whatever downturn they're in, or their strong financials will lead to strong performance in the future. On the other hand, growth companies are going to be companies that you're maybe do not have a well defined future, and a lot of their stock is pricing in rapid growth or expansion. Think about companies like Amazon or Tesla, where they are focusing on expanding their basically clientele to get more revenue and expand their services and just get more widespread as a company. And then you have value companies, which maybe as of right now, it's a lot of the energy companies are doing really well. But you also things like maybe Home Depot, Walmart, McDonald's, companies with strong, proven financials that should be able to carry them through any downturn that they're seeing. So with growth companies, you are going to be a little bit more volatile. They are going to have not necessarily higher chances of higher returns, but if the factors are in the growth company's favor, you can see very high returns in a potentially short period of time. But on the other hand, you will see very aggressive. Growth companies will be the first to sell off in any type of downturn or recession potentially. Value companies tend to hold their value a little bit more. You may not see as less you may not see as much growth in the short run compared to growth companies, but in sell-offs they tend to hold their value a little bit better. And now looking into this website, so growth and value defined. So growth companies are representing companies that demonstrate better than average gains in earnings and expected growth in their earnings. And there are no guarantees because really growth companies need certain factors to be in their favor in order to do well. If a growth company may have a good plan, a good model, and a good product, but in if they're not coming into play at the right time of potentially an economic cycle, it can hurt that company's chances of doing well. So another thing with growth companies, they tend to have much higher price to earnings ratios. So because growth companies tend to have future growth priced in to their share price already. So if you don't know what price to earnings ratio is, price to earnings in a nutshell, a price to earnings ratio is the price of the stock divided by the actual earnings per share that the company brings in per quarter or per year. And the higher the price to earnings ratio you have, the more overvalued a company is on paper. And then they also tend to have higher growth rates, so potentially they're growing, let's say 10% a year, 20% a year, whatever it is. It's going to depend on the company. And then they are going to be more volatile. So growth companies are going to be aggressively move up, and they're also going to be aggressively sold off. Think about Facebook, for example. They just posted their earnings yesterday and they were down 25%, and then they're selling off even more today. And I think they're down to about their 2015 year level share price, and they're down like 80% for the year. Amazon's getting hit pretty hard. They got sold off 20% today. So these growth companies can really take a nosedive when, as soon as that growth looks like it's stopping or slowing down, their stock price can get destroyed. On the other hand, people who are invested in these growth companies during a bull run, they are seeing amazing market-beating returns. So it really comes down to kind of timing the market. And then now looking into value stocks, they're going to be typically lower price to earnings ratios. They are usually going to have less risk overall than the overall market. And you can incorporate both in your strategy, but this is kind of just a definition of what a growth and value is. And dividend investing is utilizing value as a strategy, because dividend companies tend to be more established, proven income, reliable income, and they are paying out those dividends to their investors. And I've done a video about this before, and even in the realm of dividend investing, there's growth and value. You have what I consider to be high dividend yield being the value, and high dividend growth being the growth. And we saw that high growth companies tend to have greater capital appreciation, and then the high dividend yields tend to have lower capital appreciation but higher yields through dividends. And when you reinvest, if you were to reinvest those dividends back, they have similar performance. So now we're going to be looking into a software called TradingView, which I think is a pretty neat tool that you can use. I'm not sponsored by them, but this is a free product, and it's pretty handy to use. And so what we have here is, in teal is VUG, which is a Vanguard growth fund. In blue is an S&P 500 index fund. For this, it's the iShares S&P 500 ETF. And then shown in orange is VTV, which is a Vanguard value fund. And this is with adjusted for reinvested dividends. And as we can see, basically the idea of what the S&P 500 is, it's incorporating both value and growth into it, because it's the top 500 companies representing about 80% of the total US stock market cap. And there are periods where value and growth will kind of alternate between performance. Now keep in mind, when you're graphing like this is considering a lump sum in the beginning. And over time, the S&P 500 is going to split the difference essentially between value and growth, because it is incorporating both. And this is a good demonstration of the bull market that we're in. In this bull market that we've had for the past 10, 12 years, the growth segment of the market has been doing extremely well, primarily being driven by tech companies. And as of right now, with this current sell-off that we are in, I think this will be a good showcase of how things can change during a sell-off. So looking into end of last year, or let me see, we'll do year to date. So year to date, now during this sell-off, teal being the growth is performing the worst. As I'll click year to date. Year to date, they are down 32%. The S&P 500 is down 20%, and value is down 6.4%. And this is reinvesting dividends. Taking out the dividends, it's minus 32%, minus 20.5%, minus 8%. So both ways, value is holding its ground a little bit better, and then the growth is getting significantly more sold off, and then the S&P 500 is basically splitting the difference. So what my goal of my reason for showing this is that I think it's good to not only invest in growth or not only invest in value. I think using the S&P 500 is a good middle ground, because you are going to get the advantages of growth funds during a bull market, and then value funds when it's they're basically holding up the portfolio a little bit more. Here is a pretty neat infographic that shows the years where value has been growth and where growth has been value, because we tend to get caught up in more recent returns, especially when we are looking in this huge period where, or this period where QQQ and tech and growth is really outperforming everything. But now if we zoom out and take a step back and look big picture, value has actually outperformed growth by 4.54% since 1928. So for almost about 100 years, value has been substantially outperforming growth. And then as we can see in more recent years, as the age of technology and everything's on the rise, tech has been dominating a bit more. Here's a pretty useful research guide that I like to look into, especially it's Yardini Research. I might be butchering that name quite a bit, but it's a pretty neat website where you can see a whole bunch of relative performance sectors, and it's really detailed. I'll leave a link in the description if you guys want to check it out. But here is a pretty good visual of this is since 1998, so it's going to be focused a little bit more recent years with tech. And what it shows is growth and value tend to basically switch periods of, there are going to be periods where growth dominates and there's going to be periods where value dominates. So value shown in blue and growth shown in green, and this is relative performance to the S&P 500. And right before, basically since the Great Recession, tech has been doing very well, and now they're pulling back a little bit. And then there's still years where value outperforms. And then this is Portfolio Visualizer. It's a pretty cool back testing tool that you can use. And so I just did a quick comparison with a $10,000 lump sum investment with a $500 monthly contribution, with Portfolio 1 being Vanguard Growth, Portfolio 2 being an S&P 500 ETF, and Portfolio 3 being a Vanguard Value ETF. And when I compare them all against each other, as you can see, it's basically as shown on TradingView, growth was outperforming, and then S&P 500 splitting the difference with, let's see, a year-to-date return of value doing the best so far. And remember, these are going to be different numbers than what TradingView shows, because this is considering reinvested or investing $500 a month over a sustained period of time, whereas TradingView is considering it as a lump sum. But that's a little just getting technical. So, all right, so I'm going to try to summarize everything I just said. Okay, so growth companies. Growth companies are going to be a form of aggressive investing. You are betting on these companies that may not have a proven track record or an uncertain future, but you are betting that that company will do well and that they will continue to grow over time. And think about like how Netflix was in its early stages when it was kind of just coming out, where they were doing the mail-in envelopes of DVDs. I remember that, and that was kind of crazy. It was like, oh, it's pretty cool. Blockbuster was still a thing, and it's just like, yeah, there's this cool company where you can go online and order DVDs, and then now look where they are, $1 billion. In fact, Netflix for years they actually didn't make any revenue because or any profit, because they're so focused on reinvesting any returns into expanding their company and growing their market share. And if you had bet on them, you would have done really well in the long run. But until recently, they are down, I want to say 75% year to date or something crazy, maybe 50%. I honestly don't remember the specific number. But when growth companies stop growing, they are punished hard for having such a high price to earnings ratio. So growth companies, I think, are going to be more suitable for maybe you're someone with more, I don't not necessarily money to burn, but you're willing to be a little bit more aggressive with your investment style. And even then, I still would recommend looking into growth ETFs because you're basically hedging your bets on multiple companies rather than just a few, because you don't know which companies are guaranteed to do well in the future. So if you're only betting on a few growth companies and they happen to be losers, that sucks. You invest in like something like Vanguard Growth, or there's hundreds of growth ETFs out there, but Vanguard Growth is the most popular by assets under management. I mean, even look at ARKK, which is Kathy Wood's growth and innovation ETF. It's just been getting absolutely destroyed recently, and a lot of people are, when it was going up. What tends to drive growth companies a lot is hype. Is when a lot of people think this company's doing well, everyone's buying it. It further drives the price up, and then people tend to panic sell it off. On the other hand, value investing is, or dividend investing, I'm going to lump them together. I think when you're investing more in value or dividends, you are taking a less riskier investment strategy because you're investing in financially stronger companies, hopefully, that potentially are paying out dividends. So you're getting a cash flow from them. And as you can see here, it is, especially in bull markets, these value funds or companies tend to underperform the market in the long run when it comes to, especially when you're throwing in companies like Apple and Microsoft, Google, Amazon, driving the returns of the total market. So a lot of these value companies are kind of going under the radar until it's their time to shine, especially during sell-offs or times of market uncertainty. And then S&P 500 is going to incorporate everything. It's going to move companies in and out of the index as time goes on. So I think, especially if you have a long-term time horizon, the S&P 500 is a great way to hedge your bets. And then going back to value and dividend investing, think about it this way, which I thought was a pretty interesting analogy that I heard recently. When you're investing in these growth funds and growth companies, think about it in terms of if you're up to bat and you're in a baseball game. When you're going for these growth companies, you are trying to hit a home run essentially. And when you're trying to hit a home run, like if you're trying your hardest just to hit it as hard as you can, you're potentially more likely to miss. And if you do hit it, you could potentially get 1,000% return, 300% return in a few years, whatever it is. But if you miss, you're also very likely to strike out, because growth companies, there are a lot of small and mid growth companies who are failing to meet their expectations in growth and potentially facing bankruptcy. And a lot of those companies go under the radar because people don't hear about them, because you tend to only hear about the companies that do well. You are much less likely to hear about the companies that didn't make it. And so it's good to keep that in mind. And so with the back to the baseball analogy, you have a chance of getting high returns, but you also have the chance of just getting basically zeroed out or getting a losing company. Going back to value investing, it is a more safer style approach. And say you are, instead of going for home runs and higher chances of striking out, this strategy is incorporating the idea that let's target singles only. So let's say you are someone who can consistently hit those singles. You're consistently getting your returns. They may not be amazing returns, but you're hoping in the long run that consistent performance is going to fit your needs or risk tolerances, because instead of, maybe you're missing out on these huge gains, but you're also not missing out on the huge losses or sell-offs as much as, let's say, like the tech companies will. And let's see, I'm gonna do another comparison here real quick of basically similar idea. So we're gonna do VUG change the graph real quick. And I'm going to do VYM and VIG. So these are dividend ETFs. VYM is basically the Vanguard high dividend yield, and then VIG is the dividend appreciation. As you can see, the growth companies still will outperform these dividend ETFs. That I think these are two really solid dividend ETFs. But at the same time, when we're going year to date, I mean, these dividend funds are still going to better perform the growth companies. I want to compare VYM and VTV as well. So let me see. Because I believe they should realistically perform pretty similar. So VYM has a slight overperformance of the value. Not a whole lot, it's pretty close. But yeah, dividend companies are going to be value companies typically because they're paying out to investors rather than reinvesting into growing their company. All right. That was a lot of information. That was a lot of talking, a lot of hopefully not too much of getting on tangents. But so with all that being said, I think that value companies are a great tool that you can use to incorporate into your investing strategies to help minimize your downside risks. And when investing, you never have to go all in on a certain sector or category. You can diversify, hedge your bets. Yeah, you might be missing out on all of the huge growth during a bull run, but at the same time, your portfolio is not going to be hammered as hard during a market sell-off. And using ETFs especially is a great way to diversify your portfolio because ETFs are going to be a basket of companies or stocks, and so you're less likely to strike out. You're less likely to go crazy, but you're less likely to strike out. And still, there are ETFs that can outperform the market. I mean, even look at QQQ, which QQQ has been absolutely a monster. Um, but with that being said, I'm going to go year to date. That's surprising. It's actually basically the same as VUG, but VUG and QQQ have a pretty big overlap. But let's see, these tech companies are just been going crazy. Now, what this doesn't show you is, look at this. So here's QQQ where it peaked in, let's say, September 2000. It didn't reach that value again until 2015. It took 15 years to recover that huge bubble, that tech bubble, the .com. Whereas S&P 500, let's say it's at this value in 2000. It crossed it in 06. Granted, there was a Great Recession, but it's still things to keep in mind. When you're investing in these riskier assets, you're more likely to get potentially stuck holding bags during a sell-off. All right, so I hope this portrayed some useful information. I'm personally someone who is more value sided, but I still use the S&P 500 index funds because that is going to incorporate growth companies. And even if you look at the top holdings of any S&P 500 index, you're going to see Apple, Amazon, like all these market weighted funds are going to have these growth companies in them. So if you only had one option to invest in a fund for the rest of your life, especially if you have a long-term time horizon, I think you're better off with something like VTI, which is a U.S. total market, or VU, which is a Vanguard S&P 500 index fund. They're going to perform pretty similarly. Total market's going to have you have added exposure to small mid cap for greater diversification. And then I use dividend. My plan is to and strategy is to incorporate dividend ETFs alongside my main core holding being a U.S. total market fund. That way, in my personal brokerage account, I can start compounding dividends, and hopefully, in the long run, that portfolio will grow enough to where I can start supplementing my income with the dividends. So, I hope this was useful information. A lot of talking. Hope you guys found it useful. Thank you for watching. If you have any comments or content suggestions or recommendations, feel free to leave a comment below. I'd be happy to take a look. Thanks for watching. Have a great one. If you enjoyed the content, feel free to like, comment, and subscribe. Peace out.